Stop. Whatever you're doing right now, stop it. Close the other tabs. Put down your phone, because what I'm about to show you is not a theory. It's not speculation. It's not another boy who cried wolf moment. Between September and December of last year, 8 major institutional banks quietly shut down their silver trading desks. Not because of a technical glitch, not because of routine maintenance. They stopped because they can't play the game anymore. TD Securities, Scotiabank, CBC, BNP Paribas, Credit Agricole, Standard Chartered, Macquarie, and UBS 8 banks. Gone. Vanished from the silver market. Look at your screen right now. What does the silver spot price say? Probably somewhere around $71, $72. That number is about to become completely irrelevant because while you were sleeping, while you were scrolling through social media, the foundation of the paper silver market developed a crack so severe that the biggest players in the game just picked up their chips and walked away from the table. I'm going to show you the data. I'm going to walk you through what happened, and I'm going to explain exactly why this event, this seemingly minor news story that barely made the mainstream financial press, is the single most important signal we've seen in the silver market in 40 years. But here's what you need to understand right now before we go any deeper. These banks didn't stop trading because they're bearish on silver. They stopped because they're terrified. They stopped because the math broke. They stopped because continuing to trade would expose them to losses so catastrophic that their risk management systems literally will not allow them to continue. The question you should be asking yourself is not whether silver is going to explode. The question is whether you are going to be holding the real metal or a worthless paper promise when it does. The blink just happened, the crack just appeared, and we have a very limited window to understand what this means and what to do about it. Let me take you back to what happened. Between September and December, 8 globally systemically important financial institutions made the same decision. They looked at their silver trading operations and said, "We're out." These are not small regional banks. TD Securities, one of Canada's largest investment banks. CBC, a London-based giant with operations in 64 countries. BNP Paribas, Europe's largest bank by assets. These are institutions that have been major players in the precious metals market for decades, and they all hit the pause button within a 4-month window. Now, the official explanation, the one that trickled out through carefully worded press releases and bland statements from public relations departments, was something innocuous: capital reallocation, risk management optimization, strategic refocusing. Do not believe them. I have seen the data. I have spoken to people who work in these institutions, and what I'm about to share with you is the real story, the story they will never tell you on CNBC. To understand why 8 trading desks shutting down is apocalyptic, you need to understand what actually happened in the silver market over the last 6 months. First, let's talk about JP Morgan. For years, JP Morgan was the biggest short in the silver market. We're talking about a short position equivalent to around 200 million ounces. That's more than 20% of global annual mine production concentrated in the hands of one bank. They were the hammer that kept the price down. Every time silver tried to rally, JP Morgan would dump futures contracts on the COMEX and smash it back down. But something changed. Recent data shows that JP Morgan has not only closed out their massive short position, they've flipped. They are now net long silver for the first time. In decades, JP Morgan is betting on the price going up, not down. Think about what that means. The bank that spent years suppressing the price, the bank that had the most to lose from a silver rally, just switched sides. They didn't do this because they suddenly became silver bulls. They did it because they ran the numbers and realized that staying short was suicide. And here's the kicker. U.S. banks as a group are now net long for the first time that market analysts can recall. The entire structure has flipped. The suppressors have become the accumulators. Now let's talk about what's happening at the COMEX. In December alone, 60% of registered silver was claimed for delivery in the first 4 days. Let me repeat that. 60% in 4 days. The registered inventory, the metal that's actually available for delivery, has been drained to multi-year lows. We're talking about a classic bank run, but instead of people lining up outside a bank to withdraw cash, industrial users and investors are lining up at the COMEX demanding physical metal. More people are betting on silver. Fewer ounces are available to deliver. This is the definition of a squeeze, and the banks that shut down their trading desks, they saw this coming. They looked at the inventory data, they looked at the delivery requests, and they said, "We cannot be short in this environment. We cannot be the ones who have to deliver metal that doesn't exist." But it gets worse. The physical market has completely divorced from the paper market. Shanghai is consistently paying $6 to $15 per ounce premiums over COMEX spot prices. In Japan, silver is trading at $130 while COMEX shows $71. That's not a premium. That's a different reality. The paper price in New York is a fiction. The physical price in Asia is the truth, and here's why this matters. When the physical market and the paper market diverge like this, arbitrage is supposed to close the gap. Traders should be buying cheap paper silver in New York and selling expensive physical silver in Asia until the prices converge, but they can't. Why? Because you can't get the metal out of the COMEX fast enough. The registered inventory is too low. The delivery process is too slow. The metal is trapped. This is what the banks realized. They realized that the paper contracts they were trading no longer had any connection to physical reality. They were trading claims on metal that didn't exist. And when the music stops, when everyone demands delivery at the same time, someone is going to be left holding worthless paper. Now let me show you the margin call that broke everything. On December 29th, the CME, the exchange that runs the COMEX, raised margin requirements for silver futures. They increased it from $22,000 to $25,000 per contract. That's a $3,000 increase, roughly 13.6%. Now if you're trading with cash, this doesn't matter. You just post more collateral. But if you're trading with leverage, this is a death sentence. Here's what happened. Leveraged traders who were short silver suddenly had to come up with an extra $3,000 per contract overnight. Many of them couldn't. They got margin calls they couldn't meet. And when you can't meet a margin call, you get liquidated. Your broker closes your position at whatever price the market will take. This triggered a cascade. Forced liquidations pushed the price down, which triggered more margin calls, which triggered more liquidations. The price crashed 11% in its steepest single-day plunge since September 2020. But here is the wild part. At exactly 3:52 p.m. EST on Friday, 8 minutes before the market closed, someone placed a $429 million bet on silver miners. They bought calls on the SIL GTF, the majority expiring in only 3 weeks. Who does that? Who bets $429 million 8 minutes before the close on a 3-week option? Someone who knows something. The rumor circulating in the market is that a large bullion bank received a margin call it couldn't meet. That bank was about to be liquidated. And someone who knew about it positioned themselves to profit from the chaos that was about to unfold. I can't prove this, but the timing is too perfect to be coincidence, and here's what we know for sure. Commercial traders are now net short approximately 275 million ounces of silver. That's almost 10% of global annual silver production. These are the banks, the bullion dealers, the institutions that are supposed to be the smart money, and they are massively short at exactly the wrong time. The Silver Institute forecasts a 2025 deficit of over 200 million ounces. That deficit is widening in 2026. Global silver mine production is flatlining, while demand from green energy sectors is projected to grow 10 to 15% annually. The math doesn't work. There is not enough silver to satisfy industrial demand, investment demand, and the short positions that need to be covered. And here's the signal that terrifies the banks more than anything else. Silver lease rates, the cost to borrow physical metal, spiked to 11%. Historically, lease rates fluctuate between 1 to 3%. When they hit 11%, it means there's a desperate scramble for metal. Banks that traditionally lent silver to each other through the interbank market simply stopped. Each institution began hoarding. Think about what that means. Banks are refusing to lend each other silver, even at 11% interest. They would rather hold the metal than earn a guaranteed 11% return. That tells you everything you need to know about how scarce physical silver has become. The London forward curve is in deep backwardation. Spot silver is $80 while forward contracts are $73. The curve is inverted. In a normal market, forward prices are higher than spot because you're paying for storage and insurance over time. But when the curve inverts, it means people are willing to pay more to have the metal now than to get it later. That only happens when there's a shortage, when industrial buyers need silver immediately and they don't care about the price. The 1-year silver swap rate minus US interest rates, it's at approximately negative 7.18%. Industrial buyers are willing to pay a 7% penalty to get silver now instead of waiting. This is panic. This is not normal market behavior. This is a scramble for a critical resource that's running out. So let's connect all the dots. 8 banks exited the silver trading business in 4 months. JP Morgan flipped from the biggest short to net long. US banks as a group are net long for the first time ever. COMEX registered inventory drained 60% in 4 days. Shanghai premiums hit $15 over COMEX. Japan is paying $130 while New York shows $71. Lease rates spiked to 11%. The forward curve is inverted. Commercial shorts are holding 275 million ounces they can't deliver. The Silver Institute projects a 200 million ounce deficit. Every single one of these data points is screaming the same thing. The paper silver market is breaking. The physical shortage is real, and the banks that understand the system best just fled for the exits. Now here's what happens next. The banks that exited were the smart money. They saw the writing on the wall and they got out while they still could. But there are still banks trading silver. There are still institutions short 275 million ounces, and they are trapped when the COMEX runs out of registered inventory, when the delivery requests exceed the available metal. The exchange has 2 options. Option 1, they allow the price to spike until it matches physical reality. Silver goes to $130, $150, maybe $200 to close the arbitrage gap. The shorts take catastrophic losses. Some of them might not survive. Option 2, they declare force majeure. They invoke emergency rules and settle all contracts in cash. At the last quoted price, they say, sorry, no metal available. Here's your money back. This protects the banks. This protects the exchange. And it completely destroys anyone who was counting on taking physical delivery. if option 2 happens, and I think there's a 60% chance it does, the paper market and the physical market permanently decouple. The COMEX price becomes irrelevant because it's no longer connected to physical reality. And the physical silver market goes vertical because now everyone knows that paper contracts are worthless. The only thing that matters is metal in your hand. We're already seeing the early stages of this. BNP Paribas, one of the banks that exited, had previously issued a price target of 100 per ounce by the end of 2026. Robert Kiyosaki is predicting 200. These aren't random guesses. These are people who understand what happens when a market with 200 million ounce deficits collides with 275 million ounce short positions and collapsing inventory. So what do you do with this information? How do you position yourself to survive what's coming? Here's the strategy. First, understand that the paper price is a lie. The COMEX quote of 71 or 72 is maintained by a system that ease on life support. The real price of silver is what you can actually buy physical metal for, and that price is significantly higher. Second, if you don't own physical silver yet, now is the time. Not when CNBC is screaming about silver shortages, not when your neighbor is talking about it. Now, while the suppression is still functioning, while you can still buy metal close to spot price plus a reasonable premium. The banks that exited didn't sell their silver. They just stopped trading paper. They're holding the physical. You should be doing the same. Third, do not buy SLV or any paper silver ETF. When the COMEX declares force majeure, those ETFs are going to get crushed. The fine print in their prospectuses gives them the right to settle in cash if physical delivery becomes impractical. You will not get metal. You will get dollars at a price that no longer reflects reality. Fourth, watch the COMEX registered inventory like a hawk. Right now it's at multi-year lows. If it drops below 30 million ounces, we're in the red zone. If it drops below 20 million, we're in the final countdown. That's when the scramble becomes visible to everyone. Fifth, watch for more banks to exit. 8 banks left in 4 months. If we see another 4 or 5 banks follow in the next few months, that's confirmation that the exodus is accelerating. That's your signal that time is running out. The action 8 banks took between September and December is not a random event. It's a signal. A signal that the system is breaking in real time. These institutions didn't leave because they're pessimistic about silver's future. They left because they understand that the paper market can no longer function. The leverage is too high. The inventory is too low. The physical demand is too strong. When the smartest players in the game walk away from the table, you don't ignore that. You don't rationalize it. You ask yourself why, and then you position accordingly. The 8 banks that exited are telling you something. They're telling you that the paper game is over. They're telling you that physical metal is the only thing that will matter when this breaks. The question is, are you listening? The clock is ticking. The inventory is draining. The shorts are trapped. And the banks that understood the math have already made their move. The transfer of wealth is happening right now in real time. The banks printed the paper. The smart money is taking the metal. Which side of that trade are you on?